Welcome back to Global Macro Pulse. For our listeners, managing capital and navigating these incredibly complex markets today, we are currently observing a profound structural divergence that really demands immediate attention. We are witnessing an historic fracture. We have a complete collapse of U.S. labor data colliding in real time with some of the most violent upside spikes in the global energy markets we have seen in modern history.
Yeah, violent is the right word.
It is. This is not just a passing anomaly. When you look at the architecture of the global economy right now, what we are seeing is a systemic macro realignment, a true paradigm shift.
Look, I want to pull the lens right down to the trading floor here and put the raw numbers directly on the table for investors because the volatility we are tracking is absolutely staggering today. We just watched WTI crude West Texas Intermediate, the benchmark for U.S. oil experience, a 40% intraday amplitude.
Which is just unheard of. Just to conceptualize that for anyone listening, a 2 or 3% move in crude is a very busy day for a desk. A 40% swing is a roller coaster where the safety harness just completely snapped off. We were talking about a market that blasted up 30% to hit key resistance at $119.50 a barrel, only to violently retrace, crashing 11% down to an $81 sifting its handle.
Right.
It eventually settled at $85.15. And meanwhile, the international benchmark, Brent crude, closed at $86.23. And all of this violent energy shock is happening precisely while U.S. non-farm payrolls just unexpectedly plummeted.
It is a stunning collision of data. And we really need to frame this deep dive not as a standard morning news recap, but as an urgent, rigorous breakdown of a potential stagflationary environment that is actively impacting global portfolios right this second. The geopolitical catalysts driving the energy side of this equation are historic. Coming out of Washington on ET, U.S. President Trump has signaled that the Iran conflict is, quote, basically over. Yet concurrently, and this is the key, the administration is floating options to exert control over the Strait of Hormuz.
Which the market is actively trying to price.
Exactly, and for global markets, that introduces severe systemic risks regarding physical supply bottlenecks. Hormuz is the absolute jugular vein of global energy. We are already looking at Iraq slashing production from 4.3 million barrels per day down to just 1.3 million barrels.
Yeah.
That is 3 million barrels of crude practically vanishing from the physical market overnight. Kuwait is executing preventative cuts. Yet, at the exact same time, satellite data shows Iran is still moving massive oil volumes through Hormuz despite the intense rhetoric. We have a massive geopolitical premium fighting against physical market realities.
I have to challenge the focus on the geopolitical rhetoric here because the price action and the volume tell a completely different story. Look at the volume divergence on that crude sell-off. The market is aggressively fading the extreme war premiums.
You think they're fading it?
Absolutely. If we look at the hard data coming out of Brussels and Washington, across CET and ET time zones respectively, the G7 reached a broad consensus not to release strategic petroleum reserves at this moment. Furthermore, the U.S. Energy Secretary explicitly denied any coordinated SPR releases or export bans. The administration also excluded the Treasury from trading oil futures to intervene.
So they are stepping back.
They are stepping back, and the algorithmic flow proves it. If the systemic risk of a total Hormuz blockade were truly pricing in, WTI wouldn't have collapsed from $119 down to the $81 handle in a single session. The algorithmic flow and institutional volume divergence clearly indicate that the smart money simply does not buy the worst-case scenario. The physical market is saying one thing, sure, but the paper market is completely liquidating the fear.
That quantitative assessment of the intraday flow makes sense if you are looking strictly at the trading screens, but you cannot ignore the macro headwinds building an entirely different nightmare for the Federal Reserve. You bring up the fading war premium in oil, which is fascinating, but makes me wonder about the domestic side of the equation. If the global market isn't panicking about a sustained supply shock, why is the Fed suddenly staring down the barrel of a shrinking labor market? The shock we saw in the U.S. labor data released out of Washington, ET, changes the entire liquidity cycle.
It absolutely does change it. The numbers are brutal. Let's anchor this for a second. Non-farm payrolls, or NFP, is essentially the heartbeat of the U.S. economy. It tells us how many jobs the private and government sectors are adding or losing. For February, NFP unexpectedly dropped by 92,000 jobs.
A contraction.
A huge contraction. A sudden drop of 92,000 isn't just a slight miss on expectations. It's a massive flashing red light that the consumer engine is stalling out. Unemployment kicked up to 4.4%. And to make matters worse, we have to look at the revisions. Revisions are the silent killers of economic data, and the previous 2 months were revised downward by an additional 69,000 jobs.
So the weakness was already there.
It was baking in for months. The labor market is objectively contracting, and as a direct result of these prints, Fed funds futures are now pricing in a 50% probability of a June rate cut.
This is the exact definition of fiscal dominance colliding with a trapped central bank. Think about the philosophical nightmare the Fed is in right now. We have inflation fears being heavily triggered by the overarching threat of $100 plus oil, colliding head-on with the contracting labor market. That is stagflation, the absolute worst of both worlds, where prices are rising but economic growth is dying.
And they have no easy lever to pull.
None. The Fed is staring down a stagflationary barrel. We are already seeing the divergence in commentary from Fed officials trying to navigate this. You have San Francisco Fed President Mary Daly acknowledging the severity of the data, hinting at the pain in the labor market, while Cleveland Fed President Hammack is suggesting that rates will likely stay unchanged for a considerable period to fight inflation. They're completely boxed in.
Right.
If they cut rates to save the labor market and stimulate job growth, they risk igniting an oil-driven inflation shock, pouring gasoline on the fire. If they hold rates high to crush inflation, they push a contracting economy into a much deeper, more painful recession.
The global divergence here is what investors really need to be modeling right now, because the U.S. is not operating in a vacuum. While the U.S. is clearly facing a labor slowdown and the futures market is pricing in cuts, look at Frankfurt on CET. Traders have fully priced in 2 rate hikes from the European Central Bank in 2026.
2 hikes in Europe while the U.S. cuts.
Exactly. The ECB is entirely focused on the inflationary impulse of these energy shocks and supply chain disruptions. They are not blinking. So I have to ask, the U.S. dollar index, the DXY, which measures the dollar against a basket of foreign currencies, sustains its yield advantage with this massive transatlantic policy divergence.
It can't.
It really can't. We are already seeing the DXY drift down to 98.73. If the ECB is hiking rates to fight inflation while the Fed is backed into a corner and forced to cut by a 92,000 job loss print, the dollar loses its interest rate premium. The 200-day moving average on the DXY is going to be severely tested very soon.
That transatlantic divergence, where the traditional premium of the U.S. dollar is suddenly in question, is exactly why we are seeing sovereign capital completely rethink its allocation strategy globally. Which brings us to a fascinating piece of this puzzle today, the $5,000 gold anomaly. We are witnessing a regime change in real time regarding how sovereign wealth and central banks view fiat currency risk versus physical assets.
The volatility skew in the precious metal space is off the charts right now. I mean, spot gold suffered a massive $300 intraday plunge, dropping all the way down to $5,014.89 before immense buying pressure absorbed the shock and pushed it back over $5,136. Silver is showing similar, incredibly heavy volatility skew, eventually settling around $86.95. And crucially, we have to note the CME's tactical move. The Chicago Mercantile Exchange actively stepped in to lower margin requirements for gold and silver futures right in the middle of this chaos.
When the CME lowers margin requirements in the middle of a chaotic $300 plunge, they are essentially lowering the cost of entry to keep the market functioning. It's like a casino lowering the table minimums because too many high rollers just went bankrupt in a single hour and they need to keep the game going so the floor doesn't freeze. It is a massive signal about systemic market stress. But I want to connect that intraday price action to sovereign actions because the macro picture is striking. Let's hear it.
On Beijing time, official data reveals the People's Bank of China has increased its gold reserves for the 16th consecutive month. This isn't just buying gold. This is China building a financial fortress. They are systematically accumulating physical gold to insulate themselves. Contrast that with reports out of Warsaw on CET, where Poland's central bank is reportedly looking to sell gold reserves specifically to fund defense initiatives. And then you have the reported U.S.-Venezuela 1,000-kilogram gold transaction. This reflects a structural regime change. Gold is no longer just an inflation hedge for retail investors. It is acting as a true sovereign hedge against U.S. dollar weaponization and geopolitical fragmentation. When the PBOC buys for 16 straight months, regardless of price, that is a paradigm shift.
I'm going to push back bluntly on the idea that this is purely a sovereign safe haven play because the mechanics of the market entirely disagree with that premise. If gold is acting as a pure, unadulterated safe haven in a time of war and inflation, how do you explain a $300 intraday liquidation? That is a nearly 6% drop on the premier safe haven asset in a matter of hours. That is not sovereign buying. That is about institutional liquidity and severe margin calls. Think about how a fund operates. When funds get completely blown out of the water on a 40% swing in crude oil, they get a margin call from their prime broker.
They need cash.
They desperately need cash. they have to post cash. To get that cash, they liquidate their winning positions. They sell gold to raise cash to cover their catastrophic energy bets. We have to look strictly at the basis points and the physical discounts to understand this market. Right now, Dubai is offering $30 discounts to the London benchmark. That physical discount tells us that the paper market ran way too hot, way too fast. The physical buyers in Dubai are demanding a discount because they know the paper price is inflated. That $300 plunge was a mechanical clearing of over-leveraged long positions in the futures market, not some grand shift in sovereign philosophy.
The mechanical clearing of leverage certainly explains the sheer violence of that intraday amplitude. You are absolutely right that margin calls force indiscriminate selling across asset classes. But the underlying bid, the fact that it bounced right back over $5,136 so quickly, proves that the sovereign floor underneath this market is very real. The central banks are waiting with open arms to buy those liquidations. But let's elevate this from commodities to the broader technological and trade bifurcation, because the capital flows out of APAC are telling a remarkable story about the global tech blockade.
The tech flows are where the real volume is moving today.
Exactly. Washington, on ET, is adopting a highly aggressive trade posture right now. President Trump has confirmed a 15% tariff schedule and is actively drafting legislation to expand AI chip export controls globally. This directly impacts the revenue models of giants like NVIDIA and AMD. What we are looking at is a hard bifurcation of the global tech supply chain, where the U.S. is actively attempting to wall off the Chinese economy from next-generation compute power.
And yet, if you look at the market reaction in Asia, the raw volume divergence tells a completely different story. It suggests the blockade might be creating a localized boom. Western funds might be restricted or pulling back due to Washington's posture and compliance fears, but domestic liquidity is aggressively stepping in to fill the void. In Hong Kong, southbound capital, which is money flowing from mainland China into the Hong Kong stock market, logged a historic all-time record net purchase of 37.2 billion HKD.
37.2 billion in a single net purchase.
It is a staggering flood of liquidity buying the dip. We are seeing massive swings in specific equities as a result. Bilibili and Lyoto are highly volatile, while Tencent is actively beta testing its Q-Claw AI integration. This proves they are moving forward with domestic innovation despite the global chip blockade.
Exactly. The geopolitical narrative out of Washington assumes that export controls and a 15% tariff wall will stifle APAC innovation, but the data on Beijing Times shows an economy engineering its own liquidity cycle to survive it. The National People's Congress just set a 2026 GDP target of 4.5 to 5%, with CPI targeted at a very manageable 2%. And they are not just setting targets, they are backing this up with action.
And buybacks.
The PBOC is executing 800 billion RMB in buyback operations. They are injecting massive liquidity into their system to ensure that their domestic tech and energy infrastructure is insulated from the global macro headwinds we just discussed.
Yeah.
It is a structural walling off, yes, but one that is creating a localized, heavily subsidized boom in domestic capital markets. They are saying, if we can't buy Western tech, we will flood our own market with capital to build it ourselves.
It always comes back to the flows. Retail and institutional money in the East is simply ignoring the noise from the West. They see a 15% tariff in global AI chip restrictions, and their response is to flood the Hang Seng with 37.2 billion HKD to buy domestic tech and energy infrastructure at a discount. The volume divergence is the only truth here. Western portfolios are heavily underweight these Asian tech assets due to compliance and geopolitical fear. Meanwhile, domestic capital is buying at depressed valuations. If you are a quant watching this, you don't care about the political rhetoric. You care that 37 billion Hong Kong dollars just aggressively bought the dip on a day when the Western narrative said these companies should be crippled.
So let's take all of this. The 40% oil swings, the trapped Federal Reserve, the gold anomalies, and the APAC tech flows. And let's elevate this entire conversation to portfolio construction. What is the actual takeaway for our listeners managing capital in this environment? With systemic risks fracturing the energy markets, physical supply bottlenecks in Hormuz, and the Fed completely trapped by stagflationary labor data, the traditional 60-40 portfolio is facing severe macro headwinds.
It's essentially dead in this regime.
It really is. For decades, the 60-40 model relied on bonds acting as a reliable hedge for equities. If stocks went down, central banks would cut rates, and your 40% bond allocation would go up. But bonds can no longer act as a reliable hedge when inflation is driven by supply shocks rather than demand. Investors need to be thinking about dynamic geopolitical hedging. You cannot simply buy a broad index fund and walk away when the global supply chain is literally bifurcating into two separate hemispheres.
Bringing it strictly back to the numbers. Investors need to ignore the geopolitical noise, tune out the daily headlines, and hyper-focus on the technicals, specifically the 200-day moving averages on broad indices. If central banks are genuinely trapped with the Fed looking at rate cuts due to a contracting labor market and a 92,000 job loss print out of Washington ET, while the ECB in Frankfurt CET is pricing in 2 rate hikes, retail and institutional money must watch the volatility skew in tech versus energy.
The cross-asset volatility is the signal.
Precisely. Specifically, you need to be looking at critical resistance levels in Brent crude and tracking the capital flows in global semiconductor ETFs. If Brent holds above that $86 level and pushes higher despite the lack of a worst-case war scenario, the stagflation trade is locked in. Watch the basis points, watch the margin requirements from clearinghouses like the CME, and above all else, respect the volume. The volume will tell you where the smart money is actually deploying capital, completely independent of the political rhetoric.
I want to leave our institutional listeners with a final lingering thought to mull over as we navigate this regime change. We have spent this deep dive mapping out a world where inflation is increasingly being driven by fragmented supply chains, physical blockades in straits like Hormuz, and localized tariffs, rather than simply an overheating consumer base. If that is the new reality, can any central bank's interest rate tool actually fix the underlying disease? You cannot print barrels of oil to solve a supply bottleneck, and you cannot hike your way out of a bifurcated, geopolitically fractured supply chain. The tools of the past decade may no longer apply to the problems of the next.
Stay ahead of the curve. This is Global Macro Pulse.
Disclaimer, not financial advice.